Thanks, Poonam, for that. Let's welcome in Apurva Prasad now. Of course, a well-known IT analyst with HDFC Securities. For years, he's been tracking IT. Apurva, thanks so much for taking out time for us. Are you surprised by this buyback coming in from TCS? How would you look at it?
Yes, thanks for having me. So it is a positive. I think it is in line with their stated policies. If you see that they have a policy of returning 80 to 100% of free cash in case of TCS and about 85% of free cash in case of Infosys, cumulative over the period. So it is within that, but let's not forget that TCS is actually paying out more than the free cash it's been generating. So I think there is a lot of value equation on account of certainty factor that comes into investors with payouts going up, because at the end of the day it is a mature phase industry, and the fact that payouts increasing is certainly seen as a positive, but this is well within their sort of stated policy of paying out those kind of numbers. So prior periods of 16,000 crores or so, I mean, if you look at the quantum of payout that they have done, it can probably be even ahead of that. So that's one of it. So we certainly see that as a positive and reassuring, because if you look at the context of what's really happened in the macro environment in the past across many industries where dividends have been cut, I think this is one sector which is very clearly outperformed in terms of numbers, and with not just valuations which have got re-rated to pre-COVID, but you're actually seeing revenue performance by third quarter, you will pretty much reach the pre-COVID levels. And there are a lot of sectoral tailwinds which are working in favor of the sector. So I think in context of the fact that there is growth acceleration that we're looking at, there is a longevity of high growth period, which is again a value accretive proposition, as well as payouts which remain at a higher level with an upside risk, which we feel that tier 2 is probably where payouts can actually be going up in accordance with their growth premium. So I think it continues to be an attractive proposition from a sector point of view.
Apurva, yes, the stated policy for distribution of cash among shareholders is definitely there, but I guess COVID is something that has thrown all these policies into disarray of sorts. But nevertheless, TCS, one of the first companies to stick to that and, to announce the buyback over an Infosys or an HCL Tech, so on and so forth. So I understand, where your conviction as well is coming from. You spoke about the valuations bit. Now, do you expect the other companies as well, HCL Tech, Infi, etc., to sort of follow suit, because they as well have given a pretty positive guidance? HCL Tech too has given a very positive guidance on the margin front. So do you think that we should be seeing the rest of the, the rest in the mega IT pack as well follow suit?
Yes, so most certainly for growth. Actually, we had called out in our sector piece sometime in June that we were looking at first quarter as very clearly being bottom and recovery in the second quarter. What we are seeing now is a very strong recovery from the second quarter. And HCL Tech has come out and stated that, but we also expect strong numbers coming in from the likes of Infosys and a lot of mid-tiers who should be posting much strong numbers, such as Persistent Systems, or if it is Mindtree or even Emphasis. I think these are some of the names that will be reporting very good numbers. See, there are different ways to look at it. What are your lead indicators? Look at the large deals that some of the companies have announced. Now, incidentally, in probably one of the toughest quarters that the sector has seen, the previous quarter, you had one of the largest deal wins. In fact, their all-time large deal wins in that quarter. Now, all of that would have probably been initiated pre-COVID. But what I'm trying to suggest is that deal activity remains very strong at a pipeline level. So it's not just conversions, but even inflow into that. I think that continues to be pretty robust. And these are some very strong lead indicators to look at. If you look at globally what the enterprises are talking about spending tech and how the timelines are getting compressed. So your 10-year timelines of cloud transformation, that's getting compressed to 5 years. Or the fact that tech spend is getting priority over other spend by enterprises. I think the relevance of IT services and not just optimizing costs for their enterprises, I think it's gone beyond that, and it's seen like a very major area of investment. So I think the tech spend as a percentage of revenue is going to go up, has been going up, has been pretty robust in some of the core verticals like BFSI. That's certainly a welcome move. I think a lot of them have resumed hiring in a much bigger way versus how things were a couple of quarters back. The transition timelines, and let's not forget, these are industries which are operating still at 95% plus work from home scenario. So you are not facing any execution transition related challenges. Productivity levels are at least same, if not better. I think these are some of the aspects which is very positive. Apart from the fact that there is a lot more variability in the fixed cost structure of many of these IT companies, because if you see that the real surprise also was the outperformance in the margins. And so that's something that we continue to expect. So even this quarter, we expect margins to expand. So this is despite the USD INR move which has happened recently. There are obviously going to be some benefits coming in from cross currencies with the way Euro GBP has behaved. But even outside that, the efficiency levels have gone up. The supply side challenges which had an impact of 1 to 2% negative in the previous quarter, that will get reversed. And a lot of factors like the temporary pricing and volume discounts which was given by IT companies to their end clients, I think a lot of that will start reversing, and that will even give a much higher growth outlook to the third quarter, apart from the fact that the furlough impact, which is a normal seasonality impact, that will be much lower for the sector in the third quarter. So you're looking at a period that there are some positive tailwinds in the near term as well as medium term, and there are some very company specific factors. There are mid-tier companies, $1.5 billion type revenue run rate companies which are winning multiple $100 million type deals, and these are not 10-year deals, these are 2 to 3 year duration deals. So that is telling about the scalability of even some of those mid-tier companies, which is why you're looking at a lot of these mid-tiers are expected to go back to growth premium versus tier ones. So we expect the larger guys to, be growing at about 8-9%ish, probably closer to 9-9.5% in the near term as things recover. And for mid-tiers, about in the range of 12-13% on an aggregate. Obviously, company-specific, some names would be higher. But at the same time, near-term, we do see margins sort of remaining at higher levels. They're not major headwinds that we're looking at it. And let's not forget where it all lands is look at the incremental revenue that the sector is going to be added in the next 2 years. It is going to be greater than what it added in the last 4 years. So we're not just talking about growth longevity, but a major acceleration. That's really what we're looking at. And in that context, the fact that payouts remain healthy versus some of the industries which have cut payouts, that gives a lot of certainty factor. And that is what support PE multiples. And that is something that we've been also saying, we're suggesting that payouts level should go. Now, there would be some companies where it not targeting to pay out, we can probably look at some of those inorganic moves. So that is
right. Apurva, recently you had written a note regarding the demand recovery in the IT sector. Is that what is the factor also for re-rating of large and the mid-cap IT space? Is that something which the markets have factored in, and that's why you have seen this re-rating of PE?
Absolutely. So apart from the industry tailwind, see, it is the consolidation benefits are not just accruing to the larger companies. It is a lot of mid-tier companies who are also getting a lot of consolidation related benefits, because it's the consolidation of tier 3 vendors by the enterprise clients. So the tail vendors typically, and that is where a lot of opportunity is lying. Like I said, many of these mid-tiers, there are structural changes, so companies like a Persistent Systems, or an emphasis with what they are doing in their direct business, or an L&T Infotech with the kind of BFSI portfolio that they have. I think there are some very, very strong growth triggers in many of these mid-tier companies. And we were seeing signs of that recovery. That's when we really called out. I think those are likely to continue ahead.
Right, sir. Thank you so much, sir, for taking out time for us. Always good to get perspective from you. On that note, we're taking a break. Coming back quickly. Stay tuned. Lots more lined up.